Picture this. It's a Tuesday morning. Not a Friday, not some special occasion, just a regular Tuesday. And instead of sitting in rush hour traffic or answering emails before you've even had coffee, you're standing in your kitchen making breakfast. Slowly. No alarm went off. Nobody needs anything from you until you're ready to give it. Outside the window, the world is already running at full speed, and you're just watching it. Calm, present, not hiding from life, actually living it. Now, here's the thing most people would say when they hear that. Must be nice. I'd need like $3 million to make that happen. And look, I completely understand why that number exists in people's heads. The financial industry has spent decades making freedom sound expensive. But what if the number that actually unlocks that Tuesday morning, that quiet, unhurried, genuinely yours Tuesday morning, is a lot smaller than you've been told? What if $500,000 is actually enough? Not as a stepping stone, not as a, well, it's a start, but as the whole thing, the finish line that becomes a new beginning. I know. I hear the skepticism, and honestly, it's earned. We've all been sold on versions of financial advice that turned out to be either too complicated, too slow, or just plain wrong. So I'm not going to ask you to take this on faith. What I want to do, and my name's Harry, by the way, I should have said that sooner, is just walk through the actual math with you, and more importantly, walk through what this kind of money can do to your entire relationship with time, choice, and work. Because that's the part people don't talk about enough. Here's the core idea. $500,000 invested sensibly can generate enough income every year to cover a real life, indefinitely. Not by draining the account, not by hoping the math holds up for exactly 30 years and then crossing your fingers, but by living off the returns while the principal stays intact. Maybe even grows. That's the version of financial independence that most people never hear about because, the version they're sold involves working until 65 and then hoping your savings don't run out before you do. Let me give you the clean version of the math first, and then we'll make it feel real. 500 grand invested in a diversified index fund portfolio, the boring, evidence-backed kind, has historically returned somewhere between 7 and 10% annually before inflation. Let's be conservative and say 6% net. That's $30,000 a year, $2,500 a month, without touching the original $500,000 at all. The number just sits there, compounding quietly in the background while it hands you a paycheck every single month. Now I can already hear it. Harry, $2,500 a month isn't exactly a life of luxury. And you're right. In some cities, that doesn't even cover rent. But here's what I want you to notice. That number is a floor, not a ceiling. And depending on where you live, how you've structured your life, and whether you've got even modest part-time income or a partner with their own earnings, that floor can feel like a ceiling plenty of people never reach. We're talking about a couple who's paid off a modest home, a single person in a mid-sized city, or someone who's chosen to live somewhere the cost of living doesn't eat them alive. And look, if the conservative number doesn't fit your life yet, let's try the slightly more aggressive version. Historically, a well-diversified equity-heavy portfolio has delivered closer to 8 or 9% annually over long stretches. At 8%, $500,000 becomes $40,000 a year. That's over $3,000 a month. Every month. Forever. That's closer to a median American household income. And that's just the passive income layer. It doesn't include Social Security, side projects, occasional freelance work, or a partner's income. The point isn't to find the perfect number. The point is to realize that the number you need to be financially free is probably smaller than you were told. And that changes everything. This is actually where I want to pause for a second because if any of this is resonating, if you're someone who cares about building real financial independence and not just surviving month to month, then hitting subscribe is worth your 30 seconds. This channel is where I think through all of this stuff: investing, passive income, the psychology of money, career flexibility. Just a community of people trying to actually figure it out. All right, back to it. Let me talk about something that I think is more important than the math, honestly. It's the psychological shift that happens when you cross certain financial thresholds. Because the way you think about money, the actual cognitive patterns running in the background, changes based on your financial position in ways that are genuinely dramatic. When you're living paycheck to paycheck or even just comfortably but without much cushion, your brain is operating in what researchers call a scarcity mindset. And this isn't a character flaw. It's not about discipline or intelligence. It's about cognitive bandwidth. When your financial situation feels precarious, your brain dedicates enormous mental energy to managing that precariousness. You make shorter term decisions, risk feels scarier. Opportunity looks smaller, not because you're less capable, but because your mental RAM is being consumed by financial anxiety. There's a study out of Princeton and Harvard that found scarcity actually reduces cognitive capacity in ways comparable to losing an entire night's sleep. Think about that. Now, here's what changes with a passive income floor. When you know that rent is covered, actually covered, not covered if nothing goes wrong, your brain starts operating differently. You take the meeting that might lead somewhere. You ask for the raise without the terror of what happens if they say no. You leave the job that was slowly grinding you down. You start the thing you've been putting off for 7 years. The money isn't just paying for food and shelter, it's buying back your cognitive freedom. And that changes every decision you make. This is what I mean when I say this isn't about getting rich, it's about getting free. The difference between those two things is enormous, and most financial content confuses them completely. Let me bring this down to earth with something really specific, because I want this to feel real and not abstract. Let's talk about cars, because cars are one of those categories where the math is genuinely jaw-dropping once you slow down and look at it. The average American spends somewhere around $800 to $1,000 a month on car-related costs when you add up the payment, insurance, fuel, maintenance, and depreciation. That's across new car buyers, and it's lower if you drive something older and paid off, obviously. But let's take even $500 a month as a baseline for a modest car situation. Over 10 years, that's $60,000. $60,000. But here's the part that actually matters. If you'd invested that money instead at 7% annually, after 10 years, you're looking at roughly $86,000. After 20 years, over $260,000, almost half your way to financial freedom, just from one spending category. Now, I'm not saying never own a car or live in some extreme way that doesn't actually fit your life. What I'm saying is the real cost of a financial decision isn't the sticker price. It's what that money could have become. And when you start seeing it that way, which is the investor brain I mentioned earlier, your decisions don't feel like deprivation. They feel like redirecting. Because here's the thing about the investor brain versus the consumer brain. Neither is wrong exactly. The consumer brain is just optimizing for now. The investor brain is optimizing for options. And once you genuinely feel how much freedom those options represent, the Tuesday morning in the kitchen, the ability to say no to the job that's destroying you, the ability to say yes to the thing that scares you in the good way, the math doesn't feel like sacrifice anymore. It feels like the most generous thing you can do for your future self. Let me address what is probably the most common objection I hear: inflation. Harry, inflation's going to eat that return alive. And look, I want to be honest. Inflation is real and it matters. At 3% inflation annually, your purchasing power erodes meaningfully over time. But here's what the math actually shows. If your portfolio is returning 7 or 8% and inflation is running at 3%, your real return is still 4 to 5%, which on $500,000 is $20,000 to $25,000 a year in real inflation-adjusted purchasing power. That's still meaningful. That's still a floor. And there's a bonus most people forget. If you're in the United States and you've worked for even a portion of your adult life, you'll eventually collect Social Security. The average monthly benefit right now sits around $1,800 to $1,900. That's not a fortune, but layered on top of a passive income base, it transforms the math significantly. When that kicks in, even at 62, even at a reduced rate, your $500,000 doesn't have to work as hard. It gets to breathe. You get to breathe. There's also the question of volatility. What happens if the market drops 40% the year after you stop working? This is a genuinely valid concern, and I want to give it a real answer rather than a dismissive one. The strategy is called sequence of returns protection, and it basically means keeping 1 to 2 years of living expenses in cash or very short term bonds when you're in the early years of living off your portfolio. So if the market tanks in year one, you don't sell anything at a loss. You live off your cash buffer while the portfolio recovers. Markets have always recovered. That's not a guarantee about the future, but it is what all of history suggests. And the people who stay calm, who don't panic sell at the bottom, are the people who come out the other side with their principal intact. This is actually where a lot of people get it wrong. They think financial independence means you stop paying attention. It doesn't. It means you've built a structure sophisticated enough that you don't have to panic. There's a difference between obsessing over every market move and understanding at a calm and rational level what your money is doing and why. Now, let me talk about what this actually unlocks in your work life, because I think this might be the piece people underestimate most. Financial independence doesn't mean you stop working. A lot of people who reach it, including people I've spoken to who hit their number and fully expected to just travel forever, end up going back to something. Not because they have to, but because humans generally want to contribute, create, and connect. The difference is that when you go back to work from a position of financial independence, you go back on completely different terms. You take only the projects you find meaningful. You work with only the people you actually respect. You set your own hours, your own boundaries, your own definition of what work even means. The leverage that comes from not needing the paycheck is extraordinary. You negotiate better. You say no to bad deals because a bad deal truly doesn't hurt you anymore. You take risks on creative work, on entrepreneurship, on things that have a non-zero chance of failure. Because failure doesn't mean catastrophe when you have a floor. This is how people end up doing their best work after they stop needing to work. The creative pressure of desperation goes away, and something more intentional takes its place. There's a phrase I keep coming back to. Financial independence is not the destination, it's the permission slip. Permission to finally figure out what you actually want to do. Permission to be curious instead of strategic. Permission to show up to your life differently. Now, I want to talk to the person watching this who's thinking, okay, but I'm starting from basically nothing. $500,000 feels like a fantasy. And I hear you. I genuinely do. So let me just offer you one more set of numbers before we wrap up, because I think they matter. If you invest $500 a month, which is a stretch for some people and totally reasonable for others, into an index fund at 7% average annual returns, after 25 years, you have roughly $410,000. After 30 years, over $600,000. And if you invest $1,000 a month, after 20 years, you're already past $450,000. You're in striking distance of that number. We've been talking about this whole time. The math doesn't require extraordinary income or extraordinary luck. It requires time and consistency. And the people who start today, even if they start small, are building something that the version of themselves 20 years from now will feel genuinely grateful for. Before we wrap this up, drop a comment and tell me, what would you do first on that Tuesday morning when the alarm doesn't go off? Because I think the answer tells you more about what you're actually building toward than any number does. The $500,000 freedom thesis isn't really about $500,000. It's about the idea that freedom is closer than you've been told, that the math can work in your favor if you let it, and that the life you're quietly imagining, slower, more intentional, more yours, is not a fantasy. It's a plan waiting to be built. Start building it.